Welcome to WealthEchelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs, and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button and don't forget to turn on the bell for updates on all our latest content. If you had $10,000 to invest today and wanted to build a reliable stream of passive income, which dividend ETF would you choose? SCHD, VYM, or DGRO? All three are household names in the world of dividend investing. They offer stability in uncertain markets, consistent income, and long-term growth. But while they may look similar on the surface, each ETF follows a different strategy, from high-yield income plays to fast-growing dividend powerhouses. So which one should you trust with your money? Should you go for SCHD's powerful blend of quality and dividend growth, VYM's high-yield income approach, or DGRO's forward-looking focus on companies consistently raising their payouts? In this deep dive, we break down each fund's strategy, performance, income potential, risk profile, and long-term outlook, and ultimately reveal which one could make the biggest difference to your portfolio over the next decade. Let's find out where your $10,000 will work the hardest. In the world of dividend investing, a few names consistently rise to the top: SCHD, VYM, and DGRO. These three ETFs, exchange-traded funds, offer a reliable way to gain exposure to dividend-paying companies, making them particularly attractive for long-term investors who prioritize income, stability, and moderate growth. But how do they differ? Which one is best suited for a $10,000 investment? In this deep dive, we will compare SCHD, Schwab U.S. Dividend Equity ETF, VYM, Vanguard High Dividend Yield ETF, and DGRO, iShares Core Dividend Growth ETF across key factors such as dividend yield, portfolio composition, long-term performance, expense ratios, growth prospects, and overall value. By the end, you'll have a clearer picture of where your $10,000 could be most efficiently allocated. Understanding the three titans of dividend investing. SCHD Schwab U.S. Dividend Equity ETF. SCHD is one of the most popular dividend ETFs, known for targeting high-quality U.S. companies with a strong history of paying and growing dividends. It screens for factors like dividend sustainability, cash flow, return on equity, and 5-year dividend growth. SCHD typically holds around 100 companies and aims to capture a blend of yield and growth. Its top holdings often include companies like Broadcom, PepsiCo, Coca-Cola, and Merck. VYM, Vanguard High Dividend Yield ETF. VYM takes a different approach by focusing primarily on high dividend yielding stocks, regardless of whether their dividends are growing. It doesn't require a track record of dividend increases but aims for immediate income through high yield. It tracks the FTSE High Dividend Yield Index and has a broader portfolio than SCHD, often holding over 400 stocks, with exposure to sectors like financials, healthcare, and consumer staples. DGRO, iShares Core Dividend Growth ETF. DGRO targets companies with a consistent history of increasing dividends year over year. Its methodology requires that companies have 5 consecutive years of dividend growth and a sustainable payout ratio. The fund focuses more on growth than high yield, positioning itself between SCHD and VYM. It typically includes holdings like Microsoft, Apple, Johnson & Johnson, and JP Morgan Chase. Performance comparison. Total returns over time. While past performance does not guarantee future results, examining historical returns gives insight into how each ETF has managed risk and reward over various market cycles. Over the past 5 to 10 years, SCHD has generally delivered slightly better total returns compared to VYM and DGRO, thanks to its focus on companies with both strong dividend growth and sound fundamentals. DGRO follows closely, often beating VYM in terms of price appreciation, while VYM usually offers the highest yield but the slowest capital appreciation. As of recent data, SCHD, approximately 9% to 11% annualized return over 10 years. VYM, approximately 7% to 9% annualized return over 10 years. DGRO, approximately 8% to 10% annualized return over 10 years. If you had invested $10,000 in each 10 years ago, SCHD would be worth roughly $23,000 to $26,000. DGRO, which launched in 2014, would have grown your investment to about $22,000 to $24,000. VYM would be worth approximately $20,000 to $22,000. While the differences are not extreme, SCHD's outperformance can be attributed to its strict quality screens and strong dividend growers, which tend to outperform in volatile or flat markets. Dividend yield and income potential. One of the main attractions of dividend ETFs is their ability to generate passive income. Let's compare the current, as of 2025 yields. VYM to circa 3,2% to circa 3,5%. SCHD to circa 3,5% to circa 3,8%. DGRO to circa 2,2% to circa 2,5%. For a $10,000 investment, SCHD would generate about $350 to $380 per year in dividends. VYM would yield approximately $320 to $350 per year. DGRO would yield around $220 to $250 per year. If your primary goal is maximizing income, SCHD and VYM clearly outperform DGRO. However, DGRO offers a more balanced trade-off between growth and income, especially for younger investors or those looking to reinvest dividends. Expense ratios and cost efficiency. Fees can eat into long-term returns, especially in passive investments. Fortunately, all three ETFs have relatively low expense ratios. SCHD, 0,06%. VYM, 0,06%. DGRO, 0.08%. For every $10,000 invested annually, SCHD and VYM would cost you just $6 per year. DGRO would cost about $8 per year. These are negligible fees, and for all practical purposes, the cost differences shouldn't be a deal breaker. Still, SCHD and VYM have a slight edge here. Portfolio composition and sector exposure. Diving into the makeup of these ETFs helps us understand their risk and return profiles. SCHD is heavy in sectors like industrials, consumer staples, information technology, and healthcare. It tends to avoid utilities and real estate. VYM has strong weightings in financials, consumer staples, and healthcare. It's more diversified sector-wise, but often includes slower growth, higher-yielding firms. DGRO includes a tech-heavy tilt compared to the other two, with sizable positions in Apple, Microsoft, and other growth-oriented dividend payers. This matters because in a market downturn, SCHD's quality screen tends to protect it better, while DGRO's tech exposure could be more volatile. VYM, though more defensive, may lag in bull markets due to its lack of growth exposure. Dividend growth trends. Beyond current yield, how fast dividends grow is vital, especially for long-term investors. SCHD and DGRO both focus on dividend growth, while VYM primarily emphasizes high yield. Over the past 5 years, SCHD has grown its dividend by approximately 10% annually. DGRO also shows strong dividend growth at about 8% to 10% annually. VYM shows more modest dividend growth, around 5% to 6% annually. So while VYM might start with a high yield, SCHD and DGRO can potentially surpass its income over time through compounding growth. For example, if you reinvest dividends over 10 years, SCHD's growing income stream can far outpace VYM's flat yield trajectory. Volatility and risk. All investments carry risk, and dividend ETFs are no exception. SCHD is often praised for its relative stability, especially in bear markets. DGRO, being tech-tilted, is somewhat more volatile. VYM tends to be more defensive but also slower growing. Beta scores, which measure volatility relative to the overall market. SCHD, till cirka 0,45. VYM, till cirka 0,45. DGRO, till cirka 0,95. This implies DGRO is slightly more sensitive to market swings, while SCHD and VYM offer lower volatility. If minimizing risk is a priority, SCHD and VYM again have the upper hand. Reinvestment scenario: $10,000 investment for 10 years. Let's assume you invest $10,000 in each ETF and reinvest dividends. SCHD, starting with the approximately 3.7% yield, compounding at approximately 10% annual dividend growth and 9.5% total return annually, ends near $26,000 to $27,000. DGRO, starting with the approximately 2.4% yield, 9% total return annually, grows to $23,500 to $24,500. VYM, starting with the approximately 3.3% yield, 7.5% return, grows to $21,000 to $22,000. Reinvesting dividends significantly enhances overall return, and SCHD benefits the most due to its combination of solid yield and growth. Ideal use cases for each ETF. SCHD, best for balanced income and growth. If you want a blend of income, dividend growth, and total return potential, SCHD is arguably the best pick. It's suited for long-term investors looking to build wealth while generating consistent and growing income. It works well for both younger investors, reinvesting dividends, and retirees who want income stability. VYM, best for yield-focused income. If your primary goal is high immediate income, and you're less concerned about dividend growth or price appreciation, VYM is a solid choice. It can be ideal for retirees or conservative investors seeking steady cash flow. However, its slower dividend growth may erode purchasing power over time if inflation rises. DGRO, best for growth-oriented dividend investors. DGRO fits investors who want exposure to high-quality companies that are growing dividends steadily, even if their starting yield is low. It's ideal for accumulation phases, especially if you're younger and reinvesting dividends with a long-term horizon. Where to put the $10,000? For most investors, SCHD strikes the best balance between risk, reward, income, and growth. If you're placing a $10,000 investment with the intention of holding for 10+ years and possibly living off dividends one day, SCHD offers the most compelling combination. That said, there's also merit in diversifying. You could split your investment across all three, say $4,000 in SCHD, $3,000 in DGRO, and $3,000 in VYM, to create a custom blend of yield, growth, and resilience. Choosing between SCHD, VYM, and DGRO is ultimately about aligning your investment with your financial goals. If you prioritize growing income with strong total return potential, SCHD stands out. For high yield today, VYM takes the lead. If you're looking for long-term capital appreciation with some income, DGRO is a compelling option. A $10,000 investment today in any of these ETFs can set the foundation for long-term wealth and passive income. But if you're seeking the best all-around performer, SCHD's consistent track record, dividend growth, and defensive quality make it a standout choice in 2025 and beyond. Thank you for watching WealthEchelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.